And so something like farm machinery, 2023 is shaping up to be a great year for farm machinery demand. Prices are still through the roof for commodities. The input prices are coming down and farmers made record profits in 2022. If you're a flatbed carrier hauling agricultural equipment, you're probably going to be okay. If you're a flatbed carrier making a living hauling lumber for single-family housing starts, it's going to be a much rougher year ahead.
You're listening to Freight Famous, presented by Rose Rocket, bringing you the people that make trucking move. From behind the scenes into the limelight. Here's your host, Justin Bailie.
Hello, everyone, and welcome to another edition of Freight Famous, a podcast produced by Rose Rocket. New episodes of Freight Famous will be released about twice a month. On this podcast, we talk with guests about how they build, scale, and automate their trucking and transportation businesses. I'm your host, Justin Bailie, co-founder at Rose Rocket. I'm excited to welcome my guest today, Jason Miller. Jason has a PhD from Ohio State University and an associate professor of supply chain management and the interim department chair for the Department of Supply Chain Management at Michigan State University's Eli Board College of Business. He specializes in processing and synthesizing government and private data sources to help supply chain practitioners make better decisions. He teaches an MBA course on integrated logistics systems, a Master of Science class on distribution fulfillment, and a PhD seminar overviewing the application of economic theories to study supply chain management phenomena. This is a wordy intro. Jason engages extensively with various media outlets and disseminates similar context through LinkedIn for those that find his presentation interesting. Welcome, Jason.
Welcome. Thank you so much for having me on, Justin.
My pleasure. I did come to know you. We talked a little bit about before the show started on LinkedIn from some of your posts, and I think those of you who are listening who are more inclined maybe than I am in terms of understanding data, the economy, macro and supply chain. I think Jason is probably, certainly from my perspective anyway, I think from a lot out there, thought as a real thought leader and working in academia, he technically is. So, Jason, I think, for those of us who do know you just from your presentations online, I'd probably like to know a little bit about how does somebody become so into supply chain? How did you get here? What is your story that brought you to this point where we're talking today?
Yeah, so I did my undergrad back right in the middle of the Great Recession. I was coming out in 2010, so I couldn't really buy a job. A couple of the professors at the school I went to, we worked out together at the same time. So we would, have locker room conversations, and they pushed me to getting a PhD. I had no idea what I was getting into. But I was from Ohio, ended up going to Ohio State and getting my doctorate in logistics. The first thing you find out, you get a PhD, it has nothing to do with what you would think because it's not about business. It's about doing research. So I essentially became a statistician. And then once I graduated, your only mission in life, once you come out and you go into a tenure system job line at a university, is to publish, because that is how you get tenure. So I spent basically 2014 up really until about the onset of the COVID pandemic, only worrying about publishing, getting tenure, and that was my life, working 60 hours a week, just doing research and teaching the 9 credit hours a year I had to teach. Once COVID hit, it had just so happened that around 2018, I had started doing a lot of research, trying to sort of frame a lot of trucking phenomena from a macroeconomic context. And so I developed a lot of familiarity with some of these different government data sources. And once COVID hit, there just came this thirst of information about what was going on. And that led me to focus a lot of time and energy on that front. And then over time, I've continued to focus on that in large part due to various advisory roles that I play with the Department of Defense, Department of Transportation, et cetera, of helping translate over what is going on in the data. What does that mean from a freight standpoint for these various entities?
And so I guess bringing us to where we are now, which is, very early innings of, I mean, it's not out in the first, I think it's the first week of January here in 2023. We've come off a few, and I guess you can validate this to me, and maybe it's recency bias, but it feels like the last couple years from 2020 till now have been really unprecedented in some ways in terms of just the volatility and the binary nature between when you were talking at the beginning what 2020 looked like and then leading into 21. So I'd be interested to hear some of your thoughts around with the spot market in trucking today being at I don't know if it's a historic low, but it's very low, and you can talk maybe a little bit about that. How did we get here? I guess, it just feels like it was yesterday when the market was so flush and so high, and it just seemed to fall so quickly. And again, maybe this is what always happens, but it just feels like when you're in the moment of it, it just feels like it's never been like this before. So you can kind of set me straight on maybe the whether this is just another cycle that looks like every cycle that's come before it, or is there something unique occurring right now?
Yeah, so that's a great question and point. And what I would say is there is no precedent for the run up of spot prices and then pulling up contract prices that we really saw from about June of 2020 up through, I'm going to say about March of this year, especially on the contract market. That you can go back and look at the historical data. We've got good data back to the early 1990s on trucking pricing from the Bureau of Labor Statistics. The increases we saw, we've just never seen anything like this. And so part of it is we had such a run up, it was natural that the market would correct itself by coming down more rapidly than we have ever seen before, but it's just because we were at such incredible highs. In terms of the dynamics, it's really not much different for the most part in terms of just the overall balance of supply and demand. But what's been different really is the sectors involved. When you look at the last two freight market cycles prior to COVID, you had very strong growth in 13 and 14. That was very much an industrial fuel growth, really powered by the hydraulic fracturing activity that was taking place and creating demand for heavy machinery and, large engines and, oil field services and things like that. And then you had oil prices plunge in late 2014. A lot of fracking activity slows down in 2015, 2016. We effectively have an industrial recession in the United States. But on the consumer side, things keep growing. And so we don't enter an actual recession. But from the trucking standpoint, it was a very rough period, especially for your flatbed and your local specialized carriers. And then 2017, 2018, oil picks up. We have fracking activity really rebound. Then we had sort of the multi-way shock of a major tax cut, Hurricane Harvey, and the repair efforts from that. And then, of course, the electronic logging device mandate and the concerns about what that was going to do to capacity. So you had this sharp run up of spot prices in 17, the first half of 18. But then really manufacturing activity started to slow in the fourth quarter of 2018 and then all through 2019. We again had effectively an industrial recession, but the consumer kept spending money. COVID, everything collapses come end of March into April. The state of Michigan lost 25% of our trucking payrolls, disappeared between March of 2020 and April of 2020. So we were in a depression in this state. Way worse even than the Great Recession of 2008 and 9. But then we had this incredible rebound of demand, but really driven by consumer spending. And I think the one thing was it's almost weird. Total trucking demand in 2020 was actually less than 2019. But the lanes involved were completely upended. You had industrial activity very slow in a lot of sectors, but you had Home Depot having record sales. And so you had this incredible imbalance of demand, and that forced so much freight onto the spot market that really caused those spot prices to pull up. And then we head into 2021, We have stimulus round 2 in January that really goosed retail sales. Then sort of the event we try to forget about, but the February 2021 polar vortex caused chaos in the freight markets and created an incredible backlog of demand that moved to the spot market. And then we had the March 2023 stimulus, which will go down as one of the worst government policies that's ever been implemented, because that's what starts the labor shortfall issues. That's what causes auto sales to go through the roof and the auto shortage to really commence, which then gets compounded with the chip shortage. And 2021 was just a year that was all over the place. We've never had a year like it. Record run up of spot prices, record consumer spending. And we entered 2022. We had a lot more capacity that was starting to come online. And the big thing was at the start of the year was contract rates caught up to where carriers and brokers were honoring those contracts. Less freight rejection, less freight on the spot market, spot prices start to decline. And then by, right now it looks that freight volume peaked in the late first, early second quarter of 2022. And we've dropped a couple percentage points from there. And you have all this capacity coming online, but declining freight volumes. You have a recipe for, a market to correct itself. But the big difference has been, this time it's been more of a consumers slowing their spending, whereas industrial activity is still doing fairly well, though we are starting to see some cracks emerge in that in terms of a slowdown in October, November, and December, a little bit more than we would expect.
So would you suggest that is consumer spending then in this example, and maybe again it's a unique example, but I feel like there's probably been instances of this where consumer spending props up a market, but does the market therefore become more fickle, sensitive, and less durable because consumer spending can be such, and that the industrials really are the thing that will create the stability in a market? Am I understanding that right or interpreting that correctly?
So in normal times, it's almost the opposite in that the industrial sector can be highly volatile. So for example, during the Great Recession, we saw what I'd call industrial manufacturing, steel, large concrete blocks, machinery, things like that. That output fell 25-30% between 2007 and 2009. Whereas consumer spending fell about 5 or 6% in comparison, and that adjusted for inflation. I think the challenge now has been we were just at unsustainable volumes on certain lanes. I mean, imports were a good example. I mean, we had record import volumes up 25% from where they were before COVID. That just wasn't sustainable, especially once the housing market started to cool. And so we had, one of the big things that was really goosing a lot of activity in 2020 and 2021 was how robust housing activity was, because folks were realizing they could work from home. You started to have a lot of new home starts, 15-16% above where they were before COVID. And that continued in 2022 up till April. And then with all the interest rate increases, housing starts essentially fell 16% back to where they were in 18 and 19. But when that happens, you have less demand for shingles, you have less demand for siding, less demand for lumber and plywood and carpets and large appliances and things like that. And so that's been, to me, the biggest thing that's really pulled the freight market down is just a function of single family housing cooled. And that was a lot less demand for all these other things that trucks move.
There's a couple threads I want to pull on from that last statement, but I am mindful that I may lose track and forget to ask this question. I think the listeners are going to want to hear an answer to. Also, I'll use that as a segue, as unnatural as it might be. What is going to happen this year? So as we sit here today, what should trucking companies and brokers by extension of that expect for 23?
So I think the biggest question we have right now is just where do interest rates go? So how aggressive is the Federal Reserve? And the reason I say that is the single family housing sector is directly tied to that decision. And so a important source of demand for trucking companies is directly pegged to that interest rate. Right now, I actually feel fairly good about where inflation is at. My preferred index is the consumer price index less the shelter component, which is calculated in some odd ways that a lot of us are uncomfortable with. Because it doesn't represent, if you own your own home on a fixed rate mortgage, your shelter costs really don't change. If anything, for many of us, they deflated because we refinanced in 2020 or 2021. That measure of inflation is flat since June of this year. So we have seen no increase in the CPI less shelter. That to me is an encouraging sign that the Fed could maybe let up a little bit on interest rate increases. And if we start to see evidence that the Fed isn't going to be as aggressive, I think you will see a sharp rebound in housing activity because there is this demand for homes out there. We haven't been building homes at nearly the rate we were, since the other side of the Great Recession. So there's certainly demand for housing. It's just the uncertainty right now with where prices are at for building homes and where mortgages are going to be at that's causing builders to be hesitant. So I'd say number one thing to look for is where is inflation heading, and therefore how's the Fed going to react? The other thing I tell folks to be watching closely is where is wage growth at for the entire economy? Because that's the other piece the Fed is looking at very strongly is robust wage growth is going to raise concerns of the inflation spiral, and therefore there will be ratcheting down of rates even more. We've seen that as we're recording today on January 5th, the market really cooled down. And by market, I mean stock market, because the employment data from ADP was stronger than expected. And that's causing concerns that the labor market isn't cooling, which means wages are high. And so from a macroeconomic standpoint, that's where I'd be looking. From a much more local standpoint, if you drive in, refrigerated, or flatbed, it's where spot market rates headed on the lanes you're running. Those are the canary in the coal mine. Sort of the general sense and feeling is we may start to see a bottom towards the end of this first quarter, start of second quarter. January and February are the two slowest months of freight by far relative to the rest of the year. And so I think it's just a matter of, do we start to see those rates bottom out a little bit? And that's really a function of demand, but also do we start to see this incredible rate of new entry and capacity expansion that we've seen start to slow a little bit. And there is some evidence of that, but it seems that entry isn't slowing quite as fast as we would expect.
You made an interesting point, fascinating one, really about the drop in freight volumes in Michigan and what in reflection in a 30-day period. And if interest rates are when the interest rates, we're not raising anymore, and then followed at some point in the future of we will then reduce. But let's just say we stop the raise. Is it reasonable? Because I feel like this is whether you are a PhD like yourself or somebody like me who just sort of listens to podcasts and folks like yourself to get the information. We're all kind of using that as the absolute kind of notion in terms of like, this is once interest rates move, then all things are good. And I fear that there's more to it than that. And I fear that the tail end of that takes time. So tomorrow they say, that's it, we're cool, we're not going to raise interest rates any further. What then occurs besides equity markets maybe, because they can react that quickly. But a trucking market can't. A trucking market can't do that. A shipper isn't going to ramp up volumes 2x tomorrow. So what is the time horizon for a ramp period post an interest rate? Good news on the interest rate fronts, we'll call it.
Yeah, it'll depend very much on different sectors. So, I mean, for home building, if there's permits in place and the builders start to feel more confident, they can increase output fairly quickly. So you can see, okay, for let's say the lumber side of things, right? We can see a fairly quick shift of demand. And we saw that in 2020 when everybody wanted lumber all of a sudden because they were building a deck. Every restaurant needed outdoor seating and the housing exploded upward. So something like single family housing can switch fairly quickly. But yeah, some of your more industrial side of things, they're not going to switch that fast. And I mean, there are many sectors right now doing very well. I mean, the auto sector has a huge backlog of demand. The auto plants are churning out vehicles as fast as they can. Um, and so, we've got certain sectors are doing well. Um, and I think the other thing to really, sort of think about with this discussion is we're talking typically during most of our freight cycles, we're talking minor overall moves in freight volume. So 2019 was down 2 to 3% from 2018. Now, it feels like a lot more, but that's just because of the dynamics of pricing. The proverbial statement I always teach with dry bulk ocean shipping is if you're at a port and there's 100 loads and 98 vessels, price is going to go through the roof because every shipper wants that freight moved. But if there's 98 loads and 100 vessels, price drops to darn near marginal cost for those operators because they'll bid very aggressively. And so we see these movements sort of on the margins in terms of overall freight volume. And the one index I produce that we benchmark with a lot of other data, to the point I feel very confident saying this, volume in this latter part of 2022 is down maybe 2% from where it was seasonally adjusted at the start of the year, but the market totally turned. And so overall volume wise, we're talking movements on the margin. The challenge though for a lot of carriers is that you may have one shipper whose volumes are up 10% year over year, somebody else who's down 10%. And that freight doesn't line up, so your network's now all discombobulated and scrambled. And so what we're seeing right now too has just been, on the trucking side, just an unprecedented, this is sort of the professional economist in me, what we call a reallocation of capacity. So drivers switching from one carrier to another. We've seen that taking place in terms of just this carrier does really well and expands, this carrier does really bad and contracts. That activity was through the roof in 2020 and part of 2021. And so what we're having right now is, carriers are almost working out all the kinks of all these changes. And that was a big reason I think 2021 was such a chaotic period, was we had a high rate actually of jobs destroyed in trucking, believe it or not, carriers letting people go. But we also had a high rate of jobs being created at the same time. And so I think, sort of the long-winded take on this is it'll depend. As the Fed decides to change rates, things will vary by sector. And again, it's always the challenge with trucking is it's derived demand from some other sector that typically is derived from a different sector. And so something like farm machinery, 2023 is shaping up to be a great year for farm machinery demand. Prices are still through the roof for commodities. The input prices are coming down and farmers made record profits in 2022. If you're a flatbed carrier hauling agricultural equipment, you're probably going to be okay. If you're a flatbed carrier making a living hauling lumber for single family housing starts, it's going to be a much rougher year ahead.
Can I'm going to throw some things at you. They're really random to what we're talking about, but it's not meant to be rapid fire, but in my mind, it's kind of how it's. We'll see if it shapes up that way. But I want your kind of opinion on some topics. So I'm just going to shoot them at you. So the one thing that I've struggled with and have asked various guests and had kind of different answers to, and I think you're actually the perfect person to ask this, is freight a commodity?
So that is a great question. I think it depends on the type of freight. I mean, some freight is absolutely a commodity. Other freight is absolutely not a commodity. And so I think the challenge for every carrier, especially small carriers out there, is if you have a couple anchor shippers who provide most of your volumes, is how can you provide operations to the point that your shipper doesn't view it as a commodity? They want to come to you because you provide unique value or unique service to them. But there's no doubt some freight is a commodity. Some absolutely isn't. It's hyper specialized. Ask any chemical hauler out there. Dow Chemical doesn't have very many opportunities for who's going to go haul industrial acids for them. And so, yeah, I mean, if it goes in a dry van trailer, chances are it's much more commoditized than some type of, heavy haul giant wind turbine, because that certainly isn't a commodity.
Do you think a commodity market for freight will ever work?
No, no, because the challenge is, if you think agricultural commodities, there aren't that many origins, there aren't that many destinations. It is effectively a perfectly homogeneous product. With freight, you have tremendous variation in terms of where it's going to, when it's being generated, where it's going. I mean, millions of different lanes. There's no parallel between, let's say, dry bulk ocean shipping or even trans-Pacific containerized freight from China to the West Coast. There is no parallel to that. So no, there will never be a full commodity market for trucking the same way there is for every other true commodity.
What is your belief and opinions around the statement that there's a driver shortage?
There is not. There is a challenge that if demand really heats up like it did in 21, capacity can't be added as quickly. And so it takes a carrier 6 months at least to hire a driver, especially if they don't have a power unit. They've got to get the power unit, they've got to get the driver onboarded, even if experienced. That's an elasticity problem because they need to move freight today for which they have demand. But look at the market cycle we're in now. If there was truly a 100% systematic driver shortage, as been discussed, we would never have market cycles, because the demand shocks we saw in 15 and 16, the declines, and in 19, the decline, and even in 22, the decline, aren't enough. So no, not a driver shortage, as that term is commonly thrown out. No.
This morning I was listening to I guess a podcast of sorts, and they were these are guys who tell you what stocks you should buy and how to allocate your assets and these types of things. And they were pretty bullish on this idea around reshoring. And so the equity markets are it seems to be hedging against a reshoring effort. When I think practically, that seems like a gigantic long-term endeavor. And my challenge with reshoring, because I remember, I don't remember the timeline, but I remember a similar sentiment in the market, perhaps a decade ago, around reshoring. And it just seems like it's one of these, like, so in Toronto, we have these transit projects that start. And the particular government body that's in place to start the transit project will get it going. And then 4 years later, a new government's in place, and they decide that's not the right thing to do. So they scrap it, or they modify the budget, and anyway, 20 years later, you're ending with a project that's never going to get complete. It's already 3 times over budget, and it just, who knows where it goes. And it feels like, and maybe I'm oversimplifying this, but it feels like that initiative requires such a long-term follow-through, and it just almost feels like a here and now problem that may sort itself out in 8 years. Therefore, the energy and efforts are kind of wasted because we're never going to get off of cheap goods from China. But set me straight, or tell me I'm right.
So this is a challenging one, because the definition of reshoring is very sort of flexible. I find that folks will use. There's no doubt in my mind that a lot of the disruptions that arose due to some of China's zero COVID policies and broader geopolitical concerns in terms of our relation with China will result in a shift of some output back to North America. I think most will go to Mexico, because if you had what we would consider as an academic true reshoring, is you had a plant in the U.S. producing for the U.S. market. You shuttered at least those products being produced at that plant. You started having them produced at a plant in China, imported back to the U.S. And then reshoring means you stop producing for the U.S. in China, and you shift that production back to the U.S. You probably shifted it there due to labor costs, which means that coming back to the U.S. and the highest period of wage growth that we've seen since at least the late 1990s isn't probably your most attractive bet. Mexico looks a lot better. So my statement is will it help? Sure, but on the margins, we're talking again a percentage point or two of freight activity. Because it's not like when we started having a lot of, you know, shifting a lot of activity overseas in the 90s, but especially the early 2000s, was sort of the great offshoring period. Was like I'd say 2000 till about 2009 was the great offshore. I don't see how much of it really does come back. And what will come back, it'll be on the margins. So I think that there's a big question too I have when people say reshoring. Are you just opening a new plant in the US because there's demand for it and you're calling it reshoring? Because new plants open all the time and plants close all the time. Like, this is capitalism at work. We create jobs, we destroy jobs in manufacturing very rapidly. Not as rapidly as we used to in the 70s or 80s, but still very rapidly. Do I think computer assembly is ever coming back to the U.S. like it was in the late 90s? No, makes no sense. I mean, that's not where our competitive advantage is in low-cost, labor-intensive or assembly. So I guess I would say I think some of the projections are being overblown. Because again, a lot of these things are more on the margins. My general take is if we really, probably a better strategy would be increasing how much we can export from this country. But some of the strategies for doing that actually may not be politically attractive because the biggest exporters are also the biggest importers. And so there's a major stress that if you want to increase U.S. exports, probably one of the number one things you do is drop a lot of import tariffs to make the inputs cheaper, which allows those firms to have a lower cost structure and therefore be more competitive exporting. And unfortunately, you can imagine if you say doing that with steel or aluminum, the outcry that you start getting from the steel and aluminum industry, even though 75% of steel and aluminum consumed in the U.S. is made in the U.S.
Yeah, it's interesting. I mean, I'm sensitive to commodities being in Canada in terms of sort of import export. With the U.S., they're, I think, we're pretty large trading partners. So I certainly feel that, and it's actually interesting too on the reshoring, because in my mind, and this is probably just me projecting, but I sort of picture this 1950s utopia of we're making things here, and it's made in America or made in Canada. But I think it's, as I've been trying to understand this better, and I think you're saying it exactly, it's moving manufacturing maybe from China, which is a pretty, I think you referenced this, maybe not directly, but it's pretty politically sensitive right now. And so moving manufacturing from China to, I don't know, Indonesia or Brazil or Mexico isn't necessary. It's not reshoring. It's almost like this is just like, it's kind of the get out of China movement more than it is really reshoring perhaps.
Well, and one thing I will say, I'm very encouraged by the thought of more manufacturing coming to Mexico, which may seem odd, but when you look at trade is very regionalized. I mean, yes, we think we buy a tremendous amount from China and the rest of the world does, but put China aside for a moment. The vast majority of trade is very regional. Think of the other two largest trading partners for the U.S., Mexico, Canada. By far, the U.S. is Canada's largest trading partner. And so if you think of a lot of assembly comes to Mexico of things, let's say Barbie dolls. Well, you need plastic pellets and resins to make those Barbies. You need plastic for the shell and you need paper. Those are a couple industries the U.S. is incredibly good at. So you increase the opportunity for cross-border trade of the inputs. Whereas if it's in China and the assembly is, they may be locally producing those plastics or that cardboard because it makes no sense to import it across the ocean from the U.S. And so I think, Canada and the U.S. are definitely set to benefit if Mexico does see an increase in activity from manufacturing. But again, I think this is in terms of overall freight volume, we're talking very much on the margins, a percentage point or two spread out over, as you mentioned, years, as it takes these plants time to get up and running.
So I guess coming back to what we were talking about earlier is going into 23. The one thing I did want to hit on, I guess I have a question. Maybe this is a bit of a rabbit hole that I wanted to try to avoid, but I can't help think about it. Is that we kind of go back to the interest rate conversation, and the one thing that I guess I can't really still wrap my head around is that you've got the economy is so global now, and so you've got these different policies around quantitative tightening that are happening in the U.S. but not timed the same way in other markets, right? So you've got Europe is doing things at different stages and it's affecting bond markets at different periods. So I think that there's this somewhat, and I say this with all due respect, but sort of insular view within the U.S. around kind of like everything's kind of happening here and this is the way it is, but the world it's so much more impacted than it has been, in past around things that are happening throughout the world. So I guess just kind of back to my question around, so if we look at interest rates to be the kind of the holy grail of change, is there a but around things that are happening not within, the walls of the United States that would meaningfully impact something?
So I would say certainly the situation in Europe, especially from a U.S. export standpoint, is very key to be watching for those firms that do a lot of exporting to Europe. Obviously, there's a lot of questions right now, and my inflation concern potentially in 23 is China the next 3 months is going to be decimated by Omicron. There's just a reality that China is going through now exponentially worse than what we went through in about November through February-ish of 21 through 22. And they don't have a good vaccine. But what happens when Omicron burns through China and they come roaring back? Because that will happen. And what happens to oil prices? So from a pure demand standpoint, so much activity within countries is still domestic. The vast majority of U.S. freight is domestically originates and domestically destined. And there's a decent amount, obviously, Canada to the U.S., Mexico to the U.S. That is the vast majority of freight, though, in the U.S. is contained in the U.S. And so I worry more about Europe from a, for certain exporters, it may matter. But again, tends to be on the margins. I'm more worried about the commodity prices because right now, we have this unknown of what's going to happen once oil gets to the point that Russian seaborne price cap gets hit. Right now, we have a non-binding constraint because China's slowdown due to this Omicron surge is causing oil to be cheap. What happens, though, on the other side of that if oil starts to reach the point where the cap is in effect and the Russians actually do say, we're not shipping it if it's on the cap? Mm-hmm. And what happens to the energy markets at that point? And so right now,
so what does happen?
If they say we're taking a couple million barrels a day off of the market, oil goes through the roof. Mm-hmm. We're looking at $150 barrel oil, and we're seeing diesel prices, back to where they were in June, which is absolutely brutal, and even higher than that. So that to me is like the big upside or the big inflation concern is right now we have oil, a lot of commodities being depressed because China is getting hit really hard with Omicron. We don't know what happens on the other side of this, but obviously Xi Jinping is going to be under tremendous efforts to goose the Chinese economy to get things back to growth, given the situation he's in. And so I think that is the biggest unknown of what happens right now in the next 6 months in 23. The war in Ukraine, the commodity markets seem to have normalized. I don't think anything shocking happens there right now. Bluntly, it turns into which side runs out of ammo first. And that's sadly an open question that we have. But I don't see any commodity price shocks coming from that. It's really China. So when I look at the global economy, where I'm really focused on is commodity prices and what does that mean for costs of trucking, inflationary effects, and does that again force the Fed to hammer down even more? even though, and again, I'm not convinced that is necessarily the right monetary policy to do, but unfortunately, it's the only tool the Fed has because, as you mentioned, the Fed can't magically go build a couple more oil refineries in the U.S. That would be a 10-year, $10 billion investment per refinery.
If you were in the third-party logistics space and you had a more of a nimble go-to-market strategy where you could target certain industries and perhaps avoid ones as well. Going into 23, what are some industry? You mentioned agriculture and farm, not agriculture specifically, but farm equipment. What are some areas that you think are worth being bullish and bearish on, maybe in a relatively short time horizon over the next 3 to 6 quarters?
Bullish, energy, anything energy related, both the oil and natural gas side probably has cooled a little bit, but especially wind, hydro, things of that sort. It's hard not to be bullish on energy. Getting set up for I'm going to say the emerging EV supply chain in the auto sector, hauling batteries and things like that. That's going to upend a little bit what the freight networks look like. CNBC just had an article that, Georgia, Tennessee, or was it Georgia, Kentucky, but then my home state of Michigan here are the big winners right now with that. I think that's a sector it's very difficult not to be bullish on the EV side of things. That is where the future's heading. And again, ag seems very strong. We've got a lot of infrastructure coming, so the big, heavy industrial infrastructure side of things seems fairly robust. Where to avoid? I would not want to be hauling furniture or anything that goes into single-family homes right now. So furniture would be sort of case in point of a concern. Carpet, things of that sort would be, I'd say, a huge red flag. Trying to think other sectors.
So I see like household goods or durable goods almost. Is that sort of the same category, would you say? Yeah. Anything
sort of durable good related, I would be, household goods would be sort of a red flag right now. Clothing demand is falling a little bit. So if you're hauling, a lot of that moves in smaller quantities, but clothing would be a big sort of red flag right now. We can see Stitch Fix saying they're hurting. Bed Bath & Beyond is talking bankruptcy.
And do you think that's more an infrastructure on their side problem and not adjusting to sort of e-com and the way business is done today? Or is that a discretionary spending reduction at sort of a pre-recession or call it secret recession level?
I would say it's probably both.
Yeah.
They've had a lot of managerial issues, but there is no doubt that the consumer spending on some of those sides is certainly not what it was, back in 2021 at this time of year. One sector that still seems to be doing really good is actually sporting goods stores. We seem to have found a new fascination with sporting equipment since COVID hit.
I have as well.
And so that's been one sector that sporting goods sales have been very elevated since before the pandemic hit, and even with reopening, really aren't cooling. Another sector we haven't talked about, but I know like Forward Air, I think, is very involved with this, but things like events and whatnot. So providing third-party logistics to large events, concerts, things of that sort. I think that's going to be a very good space to be involved with this year, as people really are feeling, the pandemic's effectively, for most folks, I'd say over, other than, seemingly catching Omicron every 4 months right now and having a cold.
Yeah.
So again, I'd say there's certain spaces that are good. There's certain spaces that are going to be bad. The one thing I always tell folks is the biggest source of trucking freight is food manufacturing, and people continually eat about the same amount. And so it's always good if you can have a little bit of exposure to that vertical, because it tends to be a lot smoother and help, ebb out the ebbs and flows and things.
I think we'll kind of go out on a celebratory note, as you were mentioning concerts and events with a a 13-year-old daughter who can't wait for Taylor Swift to come to Toronto so I can spend my entire a year's paycheck on those concerts. You can see that there will be money in the network to pay for said events from these artists and promotion companies. So that will be good for her. Jay, that was really super insightful, and I'm actually can't wait to listen to it back. I have to say, when I do these podcasts, I listen to them back to hear them for the first time, because I'm trying to, I'm listening to what you're saying, but I'm also trying to think of, make sure the next question's there and I'm not stuttering, and I have a lot of, sort of verbal tics that I'm trying to, and I'm insecure about. So I'm trying to manage those. And so I'm listening to you and I'm like, oh, I love this, but I can't wait to listen to it. So thank you for spending some time with us today. I love the time of year that we're able to do this, and I'd love to talk again sometime.
Absolutely. No, this is fun. I mean, I do a couple hour exec ed session on the transportation markets, and it almost literally is, conversation like this, just free form, but then just with a lot of graphs in the background, to show folks, usually because they have to go back to their bosses and explain, why they're not getting the price discounts they wanted. I'd done one session recently.
Well,
They've done one session where one group, their bosses were expecting them to get transportation spent back to 2019 levels, and it's
Have you seen diesel prices, and how much are you paying your people today? It's
We had that conversation of, here's the producer price index for trucking. That's your benchmark.
Yeah.
It's up 38% from before COVID.
Yeah.
It's not going back.
Yeah. Great, amazing, thank you. Oh, by the way, is there anything you want to promote, or anything you'd like to tell the audience about, where they can find you, or anything of interest to you there?
Yeah, I think you'd mentioned it on LinkedIn. I'm very hesitant as a state employee to try to promote anything, and we've got a great program here at MSU, but there's also a lot of other great programs. I mean, my alma mater being one of those. So I always have a hard time promoting my program. It's like, there's so many good programs out there, and I got so many friends there. I don't want to pretend that we're actually better than you guys, quote unquote, because we're all good at what we do.
Okay. Yeah. Well, thank you, MSU, and thank you, State of Michigan, for indirectly funding your time today. So appreciate that, and be well, man. We'll talk soon.
Yep, sounds great. Hey, take care, Justin.
Thank you. Bye-bye. And if you like this episode, be sure to subscribe to the podcast, and hey, leave a comment.